Well, good afternoon, investors. Welcome to welcome to the fourth quarter of 2024. My name is Mark Robertson. I am joined here by my dear colleague from a few miles to the north, Ken Kavula. Good afternoon, sir.
Good afternoon, Mr. Robertson. I'm glad to be here, and this will prove to be a very interesting bull session today, I think.
Oh, I have to warn you in advance. First of all, let's say hello to Matt. I don't want to forget to do that. Good afternoon, Matt, joining us from Houston, Matt Spielman.
Good afternoon.
And we are going to be digging into a bunch of stuff. I was doing my best not to get 19 pounds of potatoes into an 8-pound bag. So we're gonna have a busy month going through these small companies. I think it's going to be some serious fun. But um, did get distracted a little bit by something we'll explore as we go through the session today. But there's a number of things to look at. You will notice that I have opened up the pumpkin patch. We are both believers in the great pumpkin. And that rabbit is lurking. Is that the rabbit you sent me, Ken? One of them.
I don't think so. I think that's one you came up with, Mark.
Okay, it's hard to say. We've got AI flying at us from all directions now. So AI has invaded the pumpkin patch, believe it or not. So we're going to take a quick look at the Manifest 40. We're going to finish off the discussion from Paraguay. And we're actually going to defer some of Ken's work on the small companies till next week, but he's going to actually present a two-part series over the next couple of weeks that will absolutely rhyme with our hunt and quest for small companies. Anything you'd like to add to that, Ken?
Well, no, except that some of the things that I talked about in Ticker Talk, I'm going to repeat here in bull session, and I want to say that some of the feelings that I hold about small companies actually changed my investing life 25, 30 years ago when I became very interested in these kind of companies. So I would like to share some of that with some of you. It's simpler than you might think.
And it can be incredibly rewarding. So it's just a whole lot of fun. You and I have talked a bit about my core versus non-core portfolio and how well the non-core has done, but there's a whole lot of small company core companies in my serious investing portfolio also. So good, clean fun. All right. All right, here's our weekly tribute to Portillo's, who should be a sponsor of this session, but they're not. I think we all agree that a hot dog is a sandwich. And we have evidence down there that there are a few people that enjoy a good hot dog. And just amazing how often hot dogs have come up lately in investing related discussions. But Portillo's has restored to a near 52-week high, so cause for celebration. Maybe a hot dog. All right, here's our official business. No investment recommendation is intended. Many of you have been here a number of times. You already know the guidelines, but in case you are relatively new to this, we do keep it informal and wide open. We do have a lot of stuff to cover here today, but it truly is about education, exploration, call it whatever you want. We are attempting to share the lessons learned by the Modern Investment Club movement over the last 8 decades, from the discovery of stocks to the analysis of those opportunities and the constructions of effective and successful portfolios. Please keep in mind that anything that we talk about here is an opinion or one of our interpretations. And in fact, as I hope I don't have to say it anytime soon, I could even be wrong every once in a while, but we'll see. Please come to your own decision about any company that you consider taking a position in. If we have a position in something like the previous slide, I do hold shares of Portillo's. It's a play stock, everybody. It's a play stock. I get letters from you saying, Mark, have you done an SSG on Portillo's? I'm going off of one thing. They're selling more and more hot dogs. Maybe they'll be rewarding someday. So again, keep in mind that sometimes we do these things for unusual reasons, that the reasons are up to you. If you'd like copies of these slides, or if you have follow-up questions or suggestions for topics, our 2 email addresses are there on the page. Is that enough self-confession, Ken?
It's enough. It's enough self-confession. Let's
Okay.
move on. Yeah.
Let's start very quickly with the groundhog. Again, not much to say because I'm still 72nd, but Ken has moved up nicely into that top 20 again. His colleague Don Sheets crept up another position to 12. So Michigan is well represented. We do have a Texas invasion going on, but Ken, I believe it's you that have been warning about the Bar City ladies for a while.
They're holding tight at 6 there, and
There they are.
that's a great place for them to be at this particular place. Although Investment Club of America is still, in fact, all three of those clubs, look at them, only about $1,000 apart with all three of those clubs there.
Yeah. So
The one I'm watching carefully, Mark, is Cool Kids. That's a perennial winner of our own contest here in
yeah.
mid-Michigan. And those Cool Kids know how to pick stocks, so we'll see where they end up.
Yep. A number of familiar names on there. Kim is actually up to 20th again. And I hope to join everybody at some point. Again, 4 months to go. So that means that Jim Gallagher leads at the 2/3 mark, 2/3 of precincts reporting, and he's still at nearly $3 million. So he might be untouchable. But the average groundhog is checked in at about 13%, which is a pretty good year most years. The stock market chugging away at 16 to 17%, although it'll lose a percent today, I'm sure. And the value line arithmetic average continues to lag, which suggests that there probably are some opportunities in the smaller and medium-sized companies that we should be mindful of. The monkey is fading, Ken, so I'm sure that you're okay with that.
Hooray, hooray. Okay.
All right, so we close out the third quarter of 2024. That light green bar will actually lock in as of November or September 30th, and we'll be on to the fourth quarter. But everything seems to be behaving pretty well. And again, the average return forecast is right in that 9% range. What are your thoughts, sir?
Well, it poked itself above the blue line, and that means that it was a pretty good quarter all around. It exceeded the line of reasonable expectations, not by very much, but it did exceed. I like it when MyPar and Prove and Value Lines projections are all within 1/10 of a point of each other. That just gives me a lot of validity to the kind of things that I think about the stock market.
It's good to see September finish as strong as it did because it certainly didn't hurt any of the brokerage statements that I've looked at over the last day or so. Good, clean fun. All right, here's our performance perspectives. And again, our intent here is to make a very simple point that it is possible to identify better companies, take ownership of them at better prices, and experience the numbers that you see on the top half of this chart. There are no guarantees. Please don't anybody say that Mark guaranteed that that would happen. I'm just telling you that I believe it's possible. And these numbers are significant up at the top here. Those are massive over a 10-year time frame. And again, the reminder that those companies are, and we can prove it, most widely followed by manifest subscribers. And they're also extremely consistent with holdings amongst the better investing top 100. Most closely or widely held companies by investment clubs and members of that organization. So there is a fun fact on here, Ken, that I thought was kind of interesting.
I know. I've figured it out. I didn't realize that MasterCard had done as well as it's done in the last 10 years, but it's outpaced relative return on Visa by 3%, and that's not small potatoes. That's big time. So I still like my Visa holding. There's nothing to snore at about that. But MasterCard is doing
they're both
extremely
good.
well.
They're both very good. And that came from one of the attendees of that Wednesday morning breakfast club that you're going to get to experience. So good stuff.
I will tell you, my original holding in Visa came down to a coin toss, Mark.
Between
When I
those two
first bought
companies?
Visa, I tossed a coin between those two companies. Yeah.
Well, I was surprised that MasterCard edged it up by that much, but very, very nicely done. They're both solid business models and very dominant in their industry. So again, the 10 cup demonstration portfolio and the investing roundtable, we actually think of the investing roundtable as a really cool validation of the concept of investing with your friends. And that continues to click along. And again, for those that have to invest in the more passive vehicles, that's what all these are. indices that you can, for the most part, invest in, but we call it Index Central. Nothing wrong with these numbers in general either, except they pale in significance to what is possible up above. But if that's what you're doing, again, it's good advice for somebody who doesn't have an alternative, or the lunatic addiction and hobby that we do as investors. So there you go. For those curious, here is the actual details of the Manifest 40 when they were added to the Manifest 40 by virtue of how many dashboards they are displayed on. I'm not going to go through these, just provided just to give you a sense. This goes all the way back to 19 years ago. I think Dan Hess was the one who recommended doing this, and keeping track of the companies that are most popular amongst our shareholders and our customers. And again, going back almost 19 years for most of these, the average holding period of the companies on this list is 12 years. What jumps on here for you, Ken?
Well, I think what jumps out, Mark, is the fact that in a lot of portfolios that appear, whether they're in the manifest site or in the accounting sites where they do scrapings to come up with the most the stocks that are most bought or most sold and all those things, I think you get a lot of it's not survivor bias, but maybe it is survivor ignorance, or just letting them lie and forgetting about them, because I'm surprised yet to see some of these really slow growers on this list in the top 40. And
Yeah.
yet we go down that list and there's an awful lot of growers under, let's say, 7% on that list. And we know that to put a good portfolio together, you'd like to get that growth up around 10, 11, even 12% in sales growth on the aggregate. And that doesn't leave a whole lot of room for 7 and 8% growers, let alone 2 and 3% growers.
Yeah, I mean, this type of a list is always going to be vulnerable to large company bias. So it's something
Yep.
you sort of have to live with, but it wouldn't break my heart to see some of those 2 and 3s kind of take a time out and make room for another NVIDIA or other companies like that. So yeah.
Yeah, I'm just going to pick on one company on the list. I am extremely surprised to see that Intel was 27th in the newest list and it was 27 in the old list. I would have expected a company having the troubles that Intel is having right now to have moved down the list, not stayed consistent on that list. And I guess there's that you could probably pick 10 other ones on the list that have basically stayed the same, where your expectations might have been that they were going to move in the downward direction and make some space for some of the better growers to begin to move up onto the list.
Yeah, and Intel is faced with do something or do not get well type situation, and things are pretty nasty. We talked just as we got started about CVS Health. They're out today with a restructuring potential that might actually spin off the insurance company Aetna and find a new home for Caremark. Who knows? But that's one that has languished for quite some time, and it continues to be up at the top of the list. So, and we do have an aging, algorithm in here, so it's not a matter of there's definitely a stubborn component to all of us here. All right, here's one that
Yeah, I just want to, before you get off that slide, Mark, I just want to point out to anybody that's new in the audience, and I do see a half dozen new names, that normally you look at the last column when you're looking at a chart like this and you say, oh, those are the returns, a lot of red. But you want to look at 3 columns in when you look at the total return, not nearly as much red, only a couple negatives in that whole column. That last column is the relative return, and that's how much they beat the market during that time period that they've been on the list. So not, about half of them beat the market, maybe a little bit better than half, but most of them have a pretty decent annualized total return.
Yeah, that 10% actually converts to I want to say 12 or 13% return using a cash flow analysis.
Yeah.
Accounting for the positions that have been sold. So good fun. All right, this one came up. I don't know if it was during the session or after the session last week. The Buffett indicator we've talked about from time to time. It's defined on the left. Literally is taking the value of the stock market, the capital value of the stock market, and dividing by the domestic gross product or GDP. And we're kind of up in nosebleed land up here. We've been there before. Probably will be there again someday. But this is suggesting that the way Buffett looks at the world of investing would suggest that the market is fairly significantly overvalued. He probably sees that little green notch that we talked about with the value line graph a little differently than we do. You can find that
Yeah,
indicator here.
I do want to point out that back in 1960, we bumped along that 2 standard deviations there for about 8 or 9 years. So it can stay overvalued at a big discrepancy to the historical trend for a long period of time. Uh, the swing in 60s was a good example of that, I think.
Yeah, and of course the challenges of the 1970s. By the way, this was one of the most productive periods in investing history for many of the people that were around during that time frame. If you were buying better companies at good prices, good stuff. So here is a look at Berkshire Hathaway lately, and again, this is not all Warren Buffett. This is the Berkshire Hathaway enterprise, but their sale of Apple and the various other things that they have done has raised their cash reserves to levels. I hate the word unprecedented, but in this case, it's unprecedented. And Ken, you just don't think that Buffett is pulling all the levers anymore.
I really don't, Mark. I made the point again that I think the worst job in the world would be to follow Warren Buffett. I don't think you'll be able to do anything right once he. I don't. How do you say it really nicely? Eventually, he won't have a stake in what's happening with Berkshire Hathaway, and somebody else will be in charge. And I think that person's going to have a hard time doing anything correct. And I think people are going to be brutal with whoever's managing it and however they do the management, because he's not, whoever it is not Warren Buffett anymore.
Yep, without a doubt. I got in all kinds of trouble for voicing that reality after the annual meeting, but we'll just move on at this point. Okay, just to embellish what's kind of going on the last few years at Berkshire Hathaway, and this is a subject we're going to cover in a little bit more detail shortly, so we're going to ask you to hold the thought, but it's not just cash. They've been buying back and building up cash and actually buying back a bunch of their shares. That's a picture of stock buyback on the bottom, at least partially. So we'll come back to this in a little bit of detail in a few minutes and do some head scratching. All right. Kim thought you would enjoy this one, Ken. One of the more famous hedge fund managers and successful investors for a very long time is Stanley Druckenmiller. She uses him as a source of ideas, and he not too long ago made it quite clear that he was dumping NVIDIA and buying small companies. Now he does that through the purchase of this index, IWM, Exchange Traded Fund, that represents the Russell 2000. But kind of interesting to see somebody jumping in with both feet. We're talking about $1 billion worth of stock ultimately bet on these smaller companies by somebody who's been doing this for a long time. So I found it kind of interesting. Is that consistent with what you're hearing on CNBC from our friend Tom Lee?
Uh, I
Does he continue to?
I think Tom Lee is still extremely optimistic about small cap stocks. I think, however, he's not being quite as vocal about it because I think he took a lot of heat from a lot of people about saying some of the things he said. I think quietly he still is betting on it. And if you ask him a direct question, as they do on the TV program a lot of times, he gives a very honest, direct answer, which says, no, he hasn't changed any of his ideas. But I don't think he's out there trumpeting some of the things anymore because it was painful.
Yeah, I mean, it's just amazing what can happen on social media, and I'll just leave it at that. I think that he's been fairly clear on his thinking and all that kind of stuff. I have not watched his most recent interview with Josh on the compound, but I suspect he takes a lot of this takes care of a lot of this. I will be watching it between now and next week, so maybe we'll have some news there. I did just want to point out that as a tribute to this, let's call it a conviction. We've been looking at these numbers for quite some time. A year ago, we actually were sticking away $1,000 into these, we refer to them as the Russell 2000 rascals. 4 different cases where we invested $1,000 at the round table, and you can see how well they have done. I mean, the market's up almost 38% over the last year in this particular fund, which is a triple leveraged fund. More on that in a second. If you want to avoid the leverage thing, I do think that the First Trust ETF that is shown there is an interesting area of opportunities also, and you can see that these returns have been pretty good. And that is a source of ideas. The ticker symbol is MMSC. These guys seem to know what they're doing, and it might be interesting to see if they're expressing and acting on interest in a particular stock. Anything else, Ken?
Nope. No.
Okay, you know how like when
Love the quote.
you're sitting in church and you think the preacher's talking directly to you, like right, the barrel's aimed right at you? Well, here you go. I just mentioned that it will have a huge amount of leverage in those ETFs on the previous page, and Buffett disagrees. And then I made the one at the bottom smaller because it's even more dire. So yeah, I just want to hold my hand up and say, make sure you understand if you invest in TNA that you are doing something unusual and potentially just as dangerous as Mr. Buffett says right there. Don't take your entire retirement account or take out a home equity loan on your house and do TNA. Please don't do that.
Or go out and buy NVIDIA on margin.
Yep.
Right?
Any of those things. You got to be careful because you can get hurt. All right, here is, we're allowed to look at these one more time between now and Halloween. Here is an update on the best small companies that we chose last Halloween. And I got to say, I'm happy so far. Your
Well,
thoughts, sir?
without jinxing, Mark, I can't remember the last time we had 6 of the list above 50%. I just can't remember. And this isn't just above 50, this is above 70%, the top 6. So we have some awfully good stocks on there. I'm just glad that I own 3 of them. That's all. So
Yeah.
I picked nicely. I also own 2 or 3 at the bottom of the list, folks. So I'll be full disclosure, okay? But
I do think we've got some hope in a couple of those at the bottom. Semler might be stuck, but over the long term, I wouldn't be surprised to see Celsius end up in our basket this year also. Had a tough year over the last 11 months, but there's some good companies on that list. And one point that I do want to make, we're going to go at this pretty hot and heavy for the next 30 days. And a number of those ideas, NAPCO came from Ty Hughes. I'm not sure where Nova came from. I know I presented it at the roundtable. Western Alliance, that's a community favorite. Green Brick, Matt Spielman, I believe, was one of the originators. Technoglass, I think Ken might have Technoglass as middle names for some of his grandchildren.
well, actually, I brought Western Alliance and Technoglass to the
Okay,
list, both of them.
we'll
So
let you claim credit. So
I'll claim both of them, okay?
the point I'm making, I know Monolithic came from outside the community as well as a number of others going down that list. It is a community effort, and we greatly appreciate when compelling / intriguing ideas come to us. So for
But
now,
and
go
I
ahead, Ken.
want to move over to that third column again, Mark, and point out that just because the relative return is negative, I still think that if I owned MedPace and had a 36% return this last year, that I would accept it.
Yeah, we'll
And
take
the
we'll
same
take that.
thing's probably true about Montclair. Even though it has a negative relative return, I'm not going to throw any stock with a
Well,
27.7% return out of my portfolio. So
Ken and I have
at
discussed
least not
recently.
immediately. Yeah.
In fact, I had a discussion with Kevin Gologly about the same topic of individuals and investment clubs who will attack holdings that have some red ink, as part of the agenda. And again, the point that can be made is that it really is the combined performance. Think of this as a team. Not every player is going to have a good day or a good year, but it's really what these all add up to that matters. And that 51% is pretty cool. Now, if you're like me and you only invested in the bottom three with real money, that's a different walk in the park or the woods.
I will say, Mark, that InMode is having a terrible day today. My wife and I own InMode in one of her IRAs, and it's having a terrible day with all the rockets raining on Tel Aviv right now. So,
Yeah,
uh,
Well,
before
it is more than that too, Ken. There was an
well, they
article.
just, oh,
They
okay.
have a number of,
You're going to tell me they got rid of all the people in North America that were in charge, right?
yeah. After doing so in Europe.
Yeah, yeah.
you're saying
They,
Inmo did that, can I get that one? Might have missed that.
InMode,
Yeah.
well, they wish them well as they kick them out the door.
Really?
Yeah, it was not retiring to be with family or better opportunities. It was changing the company structure. So
Yeah,
sweeping out.
but the entire North American leadership was gone now. So and the CEO of the company indicated that he is now going to take a personal interest in what's happening in North America. So we'll see where that leads.
I'll take a deep breath, and you know what the situation at my house, Ken, so I'll just leave it at that for right now.
All right.
I have daily experience with that type of sentiment. Let's hope that it's an improved situation for all involved. All right, let's go ahead and switch gears. Again, this is, if you weren't with us last week, just sharing some correspondence from Paraguay. Ken and I have added that to our long-term travel itinerary. We would like to go to Paraguay. Ken is being reluctant about it, but he just doesn't know how much he wants to do it yet. Um,
I just said I didn't want to drive. Okay.
all right. Well, if we could fly in there and have a good time, but again, I thought this was a pretty good email. I did talk to Alejandro between last week and now. He thoroughly enjoyed it. He was basically sending us a set of questions that inspired us to go back and kind of rekindle our better selling disciplines. So we'll cover those just briefly here, but going to move on to this study of non-core companies also. Again, these have not changed. These are the three main rules: make the portfolio better if the fundamentals or quality are in decline. And by the way, Ken, I was inspired by last week's discussion to perhaps add a metric, and that's just simply year over year change in quality that we can take a look at and make some decisions about. Could we possibly be triggered into an evaluation of a company that is undergoing a downward trend in quality? And it actually works the other way too. Quality going up could be an interesting thing to look at. So we'll be talking
I'm
about that
I'm
soon.
wondering, Mark, if we might even make it a shorter metric than a year, maybe 6 months or even a quarter of a quarter.
Yeah, we can
Because
do
a lot
that.
of times quality is the first thing to start to move when a company's having issues
Yeah,
in both directions, by the way, in both directions. Yeah.
as I hear you thinking out loud with me, I mean, I'm moved by Nicholson really wanting to focus on year over year, but at the same time, I think the answer to your question or suggestion is probably both. Maybe a 1 year number and a 3 or 6 month number also to try to
Yeah,
catch
what
and
I
trend
what
it.
I liked, Mark, is that when we might show it again today, with that when we discovered quality was degrading, we saw that we had in a lot of cases an extra 3, 4, 5, 6 months to actually consider and then get rid of the stock, and it still preserved most or all of the capital we were trying to preserve.
Precisely.
So it's a relatively short thing, and maybe a year takes us outside of the safety zone.
Could be, could be. So both is probably the answer. I know the year is easy, so that'll be first, but we will build on that. And then, of course, if you need the money, you typically find the lowest return stock in the portfolio or somewhere near the bottom of the portfolio when it's sorted by the lowest return forecasts. This slide doesn't change. Just a quick reminder that we believe that the output of any stock study is the most important element. This is what Ken is talking about, these wiggles and waggles in quality. Now, Costco doesn't wiggle and waggle. That's what part of what makes it very special. But watching those trends and acting on opportunity as the result of these studies, the studies work. All right, so
And we're not nearly as concerned about wiggles and waggles up between 90 and 100 as we are between 90 and 70.
very true.
We've discovered that wiggles and waggles between 90 and 70 are much more important than what goes on between 90 and 100.
Absolutely. All right, so here is one of the questions posed that we talked about briefly last week. We thought we would continue and try to come to a better result here. And Ken was curious what page TBD is. And I advised him that that is the book that we haven't co-written yet, and that's just an opening for a page number. But I believe that we both
I'll
believe
write
this
the
will.
forward, Mark, okay?
All right. All right. So do you believe when you think about selling a stock, should it be influenced by whether it's core or non-core? We think it's intuitive. We think it's pretty much intuitive and want to explore what might that look like. But first, isn't this true also? It's not just the selling consideration. So from page TBD in a book that doesn't exist, how do we handle this? And here's a look at Apple. We've talked about this a number of times. Again, you see the consistent company, decent. It's not an incredible grower anymore. It's a very mature company, but a pretty decent situation. And on this summary of stuff, again, we see a return somewhere in the 5 to 6% range based on the assumptions that were made during this particular study. And this comes with a fairly simple question. We generally are out there looking for companies that are at 13.5 as a minimum when the average stock right now is at 8.5. What do you suppose this could be all about? We're willing to settle for 11% for a company like Apple. And this is something we wanted to show because I've had this come to me via comment on a number of companies like Apple, including Costco. And here's kind of the situation. You're looking at a long-term track record of the return forecast measured as the par over that's a little over a 10-year period. And then here's kind of an exploded version of that same green boxed in area. And what I want you to notice is how often Apple above 14 or 15, how often over the last 5 years has it been above that arrow? How often has it actually been that high over the last 10 years? And the answer is not very often. The flip side would be how often has it gotten close to zero? And there's only one in this period right here. So it has not approached what you might think of as a potential selling consideration trigger very often either. But this is a case where you can take a company and perhaps not shoot for market average +5. You generally want to do that, but sometimes for a high quality core holding, you can target it for a little bit less. Is that fair enough, Ken? Does that get the point
Well,
across?
not only is it fair, Mark, but it fits right into the philosophy that we've been talking about holding about 25% of your stock portfolio in these large, very stable companies that don't too often go on fire sales, but at the same time they don't too often disintegrate in front of your eyes either. Apple's a great one to have in the 25% of your portfolio that provides the balance to a well thought out, well constructed portfolio. So I don't have any problems at all holding a stock like this in the portfolio. The problem becomes when the percentage of Apple stock or whatever the stock happens to be begins to override the 25%, and it begins to become the tail that wags the dog. This slower growing company begins to set the tone for the entire portfolio. At that point, maybe you do have to bite the bullet and trim a little bit of away, sell a little bit of it, put it into something faster growing, a good medium-sized workhorse, a strong possibility is in a small company, but I think too often we let great stocks that we really appreciate, we really love, we let them take over the portfolio, and that's not for the good of anybody when that happens.
Absolutely. So in this case, the maximum projected annual return during this 5-year window happened right here. And I am going to take a mini bow, and I told you so. Because during the roundtable back in November 2022, near that relative low in the stock price of Apple, you basically had that opportunity, and it's worked out pretty well. And my detractors might say, well, that's the blind squirrel taking over again. It really isn't. I mean, it's our methodology, and I will defend that methodology when it comes to identifying opportunity. And I just think that this is an example. They don't all work out, but this is a pleasant one to have to be currently experiencing.
It's really great, Mark, to look at these chronicles that exist in Manifest, and first of all, to always check for a nice, relatively straight horizontal blue line. That indicates, pretty decent quality. Make sure it's at a pretty decent level, maybe 80 or above. But then the next thing that I always look for is I don't pay a lot of attention to the green bars, because they're essentially telling me almost the same thing as the red line is telling me. I just like to buy a stock when that red line is up near the highest that it's been on the chart. And usually I'm looking at the end of the chart. I'm not looking in the middle of a chart, because I'm looking at the most recent time when I'm going to make a buy. And I want to see that par value either at what do we get, about 2.5, 3 years on one of these chronicles, Mark? Is that what we get?
About 5 years by the time you
About
factor
5
that in.
years.
Yeah.
Okay. All right. So I would like to see that red dot at the end of the graph be near a 5-year high. And when I can see that happening, I know that I've found a stock that I really want to own then. That's what Mark's pointing out when he points to that green bar, or he points to that red square up there, which is the highest one on the entire graph. Yeah.
And you can really see it up here with the multi-year look. I mean,
Yep. Yep.
All right. Good stuff. All right. So for that high quality core holding, we think that trigger should be pretty close to money market rates or lower. Now, money markets have ranged from 0 to 5% over the last couple of years. So you want to factor that into the situation. But like we went over a little bit last month, sometimes for a really high quality holding, you probably should forget that money market rates are at 4 or 5% and go with 0. And that's what we're kind of demonstrating here. Basically, you wouldn't want to sell this stock. Well, first of all, you want to buy it at 179, but you wouldn't want to sell it until it got up to a price of about $300. Currently at
And
233.
we should give credit to Mr. Nicholson, who gave us a quote that we put on the bull session last time or the time before, that where he indicated that he urged us not to sell things where their earnings and their sales were both in double-digit growth categories. No matter what the par might be, where their earnings and their sales were in double-digit categories, he liked to see us try to hold on to at least part of that stock, if not the whole thing.
So again, keep in mind that our selling trigger is based on that return forecast. So for a high quality core holding like Ken was just describing, we're looking at pretty close to 0. And then just to show you how much the conservatism can be built in, if you're looking at a more average company selling around money market rate, you'd be willing to sell that company at closer to where the current price is now. And then if it's non-core, you should have already sold it, because again, this is the current average price or average return on the stock market, and this company is below that. So if this were a non-core company, it might already be in the quote unquote sell zone. So
I think the title of that last column is short leash, right, Mark?
Yep. So you buy them higher, on a higher return forecast, you require them going in, and you're willing to sell them at a higher return forecast. And that's what the leash has all about. So again, the price that you're willing to consider selling a stock is a function of what type of company it is. Again, we think that that should be instinctive or intuitive. All right, so let's go on and tackle just a little bit of the question from Paraguay about dealing with non-core companies, a little bit earlier stage companies. This is an area that Ken and I get into a bit of a tussle every once in a while. I think I've converted him most of the way, but he really breaks out in a cold sweat in the hives the farther we go left on this chart, and I get that. And again, this is where we live and play. We like to see companies with demonstrated history. So somewhere in here is our sweet spot for keeping track
Especially
of
for small
companies,
companies now, right, Mark?
especially for almost any company.
Okay.
But
All
yeah,
right. Now that you made the box bigger, I thought you were going to make it very narrow. Okay. The big box for any companies, if you want to keep that box in number 3, then it's a very narrow box, but that applies to really decent small companies then, yeah. What the disclaimer that we use this kind of a chart in a lot of the education that's done, whether it's manifest investing or better investing. And the one thing that I like to always bring up for our audience is that the chart tends to suggest that each of these stages is equal in length, but we're not defining the horizontal axis in any way, shape, or form. And any one of these categories can be much wider than the chart suggests. So we're not saying, you know, every 6 months you go into a new place, or every 3 years or anything like that. These boxes probably all have different time periods attached to them, depending on what the company happens to be.
yeah, they definitely do. It's a function of industry, whether you're selling Portillo's hot dogs, McDonald's hamburgers, or Commodore computers. I mean, it's gonna have a different time frame associated with it. So
I,
here's a
I think the other thing, Mark, is that it's possible for that blue line to go roughly horizontal rather than move down into decline. We
for a
don't
long
have a
time.
lot of companies. Yeah, we don't have a lot of companies that are, you know, have aged really well, but we do have companies that have moved into the 70, 80, 90, 100-year time period, and they're still returning capital. They still have things going pretty well, and the blue line could be said to be horizontal or tipped ever so slightly in an upward direction even.
Right. In fact, you heard us both tugging at our heartstrings about those companies on the Manifest 40 that are here, somewhere here, and 2, 3, 4%, growth rates. And you just have to know to be vigilant for a decline. Again, no one knows when that section 4, how long it's going to last on that graph. But that's one of the reasons that those companies bother us, because we know what can happen to them. All right, so
And of
recognizing,
course,
go ahead,
of
Matt.
course, the companies can go back down the graph into new lives, right? That's what you hope for too. You were talking about age. Microsoft is 50 years old next year.
Yeah, yeah.
Doesn't act like it.
Well, and Matt, we've done long-term studies of Apple and Microsoft both, where we've showed that they've reinvented themselves 2 or 3 or more times, and you see cycles going on where that profit begins to move in the downward direction, and suddenly you have new products, a new thrust for the company, if you will, and the lines begin to move up again. So we're very aware that this is just a really generalized picture, and it's not to be used for any specific company at any specific time.
Yeah, and I think the point that Brian Feraldi is making here is that, uh, again, we use PEs in the construct of our stock selection guide results. So we're down in this PE box here. This is where PEs are going to be most useful in these zones going out here, and to a lesser extent to the left of that. But keep in mind that an early stage Amazon, somewhere in this time frame here, really didn't look very good on a stock selection guide because of what happens to PE ratios at that point on the chart. So that's what Brian is getting at, that for companies to the left of where we like to be, just less useful. So when you hear somebody refer to a company as a better investing type stock or an NAIC type stock, they're generally referring to part of Section 3, all of Section 4, and maybe a little bit into Section 5 is where we really find to be a comfortable neighborhood for our analysis. Anything else you'd like to add, Ken?
No, I think that he does a nice job of telling us what things are useful where, and I think more importantly, what he's trying to do is to guide us away from the idea that every single financial metric is good at any place in a company's growth cycle. It's just not.
Mm-hmm.
You can't go down a value line sheet, look at every single number and call it important. Depending on where the company is in its growth cycle, some of those numbers just aren't the kind of numbers you want to look at certain points as the company is trying to establish itself, or maybe as it's moving now into the end of box 5 into box 6 even.
And someday I'm going to have a discussion about why our asset sales always not useful with Brian. With Brian. Well, here's something that I believe, and again, don't take this as the ultimate, but I believe that the work we have done on projected return and enterprise value is helpful in this area. I do think it's more useful over the life. Okay, I'll throw this one out. It's never useful out there, but again, I think that the approach itself actually does lend itself to more utility over the entire life cycle.
Well, if I can bargain you down to the second block on the bottom line and make it somewhat useful, then I would buy your chart. You know?
Okay, done. Next time I show it, it'll be somewhat useful.
Because yeah, I think it becomes useful as the company comes closer to break even, and it allows you to look at the company right before it starts to break even. I'm just not so sure when a company's at the bottom of its losses that anything's very useful to help us figure out what's going to happen next. And that's where you need the price to hope ratio on a line down there. Then, Mark, that'll be very useful. 1 and 2.
I don't think that the price to hope ratio is ever going to really work out, especially for Section 1. But the one other warning that we should give people who are relatively new to early stage investing, and this includes you, Alejandro, if this goes up here where the profit breaks through and goes positive, and then it goes back down here, that's usually terrifying to the world of investors out there. And this usually has a very high penalty associated with it. So anytime it reflects or deflects off of going positive when it comes to profitability and then reverses course, even if it's got a lot of good reasons for it, it gets hammered. So just something to keep in mind that you want to be aware of when you're doing early stage investing.
And unfortunately, that's a lot more common than you might believe. Yeah.
I believe that's true. So one of the reasons that I think that the methodology works is because it really does focus in on the operating margin, which is going to basically shift everything. If you change this profit to operating margin, it's going to shift that entire graphic to the left and basically move you towards where we can actually do something more meaningful. And again, this is just the definition of operating margin. It's the number in the numerator of the projected return on value calculation. So you see what's up there in the numerator. And we really do believe that it's more consistent, less turbulent than the bottom line, which is going to have all of the tax associated accounting and special situations in it. So it's an area where we think that it offers a little bit of a refuge. It's not guaranteed. Nothing is. All right. So again, that's why we encourage looking at this for any company. You know, how's their operating margin, their operating profitability behaving over time? How is it trending versus that bottom line? Then that margin would simply be the earnings per share expressed as a margin. And I believe that the operating margin characteristic or trend can really help you identify where you're at on that chart. Anything you'd like to add to that, Ken?
Nope, not at all.
You know, this basically says to me that apparently we don't have enough McDonald's yet, because that green line is still going up, or at least they're figuring out. I don't know if they can add another version of breakfast, but whatever they're doing, they are continuing, somewhere in that sweet spot zone that we recognize as Section 4 or Region 4 of that. So coming back to projected return on value, again, this is inspired by Greenblatt. We have done sessions on this. We will probably do other educational sessions in the not too distant future, but I really think it captures an opportunity to come back full circle, focus on the revenue characteristics of the company in its life cycle, along with the profitability, which is what was shown on the original stock selection guide. And then those are basically the talking points. And the major changes are shown in red here. We're dealing with projected 5-year out operating income. And again, that's where it gets a little bit dicey. You're making a 5-year estimate. And then we converted debt, total long-term debt, and switched it to liabilities, and really liked where we ended up with the entire situation. So you can read the bullet points. I did add this, Ken, because I think this is what it is offered or enabled for a large part of our community of investors. I really do think that if your PAR compares to the projected return on value, the PAR versus the PROVE is out of line by a fairly good measure, that it's probably time to think, is my PE projected PE a little high or a little low? And it really makes a lot of sense as you crunch through a whole bunch of studies. Your thoughts, sir?
I agree 100% with what you're saying so far, Mark.
Uh-oh. That means less than 100% is coming here.
Foreshadowing.
Foreshadowing. All right. So let's talk about this subject, which actually kind of derailed me a little bit this weekend. It's kind of a strange topic. I'm not an accountant. I mean, I passed all kinds of accounting classes, but I'm not a registered accountant, so I can't speak to the nuances. And I'm going to actually take up some of these conversations, but we're going to talk a little bit about treasury stock with respect to companies. And literally, it is buying back stock that is outstanding, pulling it back inside the company, reducing the number of outstanding shares, as it says here. And that's where it begins to get a little bit interesting. Any editorial comments yet, Ken? You're okay with Investopedia? All right. So here is an example of a company that is dramatically, whether it's Abbott or name the companies, Coca-Cola, whatever, you see this steady downdraft in number of shares outstanding. So they're basically repurchasing their shares. In the case of Honeywell, they've actually been converting them into treasury shares and retaining them on the books, so to speak. So you actually see a fairly significant number here. So that's just one example. And you contrast that with this one. I mean, Apple has retired over $7 billion or 7 billion shares. I don't know what the dollar amount is, but 7 billion shares, and taken down a large piece of their outstanding shares, and they do not turn it into this treasury stock. They basically retire the shares after they acquire them. So I'm kind of stunned at the two pictures. And
This name Treasury stock, folks, has nothing to do with U.S. Treasury bonds or
right.
U.S. Treasuries of any kind. Think of it as company Treasury stocks or just company shares that they hold. That's just what they call it, Treasury. And don't try to relate it to anything in the government. I can hear some of your wheels working and trying to figure out, how do you get government shares involved with the company? You don't, okay?
So, in a nutshell, this bothers me. I don't understand the difference between the two techniques. I want to understand the accounting, the strategy a little bit better. And I will tell you, I have no shortage of renowned textbooks in the realm of investing. I mean, dozens. I went through most of them, if not all of them. I also used every AI device known to man to try to come to grips with this a little bit. I got a lot of good definitions and and good verbiage, but I was still left a little bit confused. And I don't know if I'm going to get unconfused, but I basically would like to lay this out because I had given a presentation on the subject of projected return on value, and one of the members in the audience happened to be the chairman of Dollar General. And he came up to me after the presentation, said, "What you've got is basically spot on. You probably should also use it to take a look at share repurchases, stock buybacks, and the impact on the enterprise." So I take somebody like that pretty seriously. He's a bright guy. So I get the one up at the top. Basically, the one up at the top is showing you the situation of, okay, I've got a little bit of excess cash. I'm going to spend that, basically write a check from the checkbook, as the operating officer of a company, and basically buy back the shares from somebody. Now, let's say Ken has $1 million worth of shares in my company. I'm going to send him a check for $1 million, and we're going to rip up Ken's stock certificate. So the fact that that is happening, we're ripping up Ken's stock certificate, you're reducing the number of outstanding shares at that point, and you will boost earnings per share because the shares are going down. So I think I completely understand this transaction so far. Are you okay with this one so far, Ken?
I don't have any problems with this formula that you're using right now, Mark. My troubles are in the next formula.
Okay, and they're mine too. I still don't know what to think about this because we see that some companies like Apple actually do this transaction. They assume ownership of those shares that they are taking off of the market, and they literally tear them up. Other companies do other things, and they create this category known as Treasury Stock. And I still don't know what to think of it. I want to talk to a couple of accounting aficionados to come to a better understanding. Right now, I'm kind of left at the point of thinking this as some form of variable currency or something. And the next question becomes, well, how widespread is it? How material might it be? How should it be thought of? Because it's kind of annoying to this, at least to this engineer. So Ken, you don't like the formula. I get that. I still want to
Well,
understand better.
here's my thoughts. I view treasury stocks the same way that I think I would view a company having a substantial line of credit with Goldman Sachs or somebody like that. It's money that they can draw if they need to. Goldman Sachs tells them how much they're entitled to. Goldman Sachs is going to charge them a little bit of a fee, of course, because that's another institution. But I see treasury stocks as nothing more than a potential source of revenue. It's a line of credit. And in my mind, as long as it's not used, it doesn't have any value to it. And I would not include it in the enterprise value unless it was used. And once it becomes something that's used, then I think it should be included. My instincts on a formula are always to keep it as simple as you possibly can keep it. I like the fact that par and prove, when they're both well done, when they're both speaking the same language, come out to be roughly, or in a lot of cases, almost exactly the same number. And I'm not willing to go through another process now, change the formula, and then try to figure out what the new proof is telling me. I'm just not willing to go there. So
Yeah.
That's where I am with this adding treasury stock at this particular point. Again, I think it's sort of like a line of credit and should not be considered part of the enterprise.
I guess I would have to work through an understanding of the accounting because my perception is a little different than that. And it really is, it's tangled. Again, I do have some understanding of accounting. It's actually treated as a contra asset on the balance sheet. So it is in there. And then I've used a couple of examples just trying to work through an understanding of this. I mean, what if McDonald's had set aside $1,000 worth of Kevin Galogli stock 20 years ago and put it in a shoebox on the desk of the on the treasurer's desk. He pulls that $1,000 worth of stock 20 years ago, out of the shoebox on his desk. It's now worth $50,000. He can go and use that $50,000 on anything that would make McDonald's better. So that's there. And then, as I got into looking at a variety of companies, just as a case in point, ExxonMobil paid using Treasury stock for the acquisition of Pioneer Natural Resources. And that happened within the last quarter. So it's, I want to understand the accounting a little bit better. I want to figure out how material is it. Maybe it is truly negligible and rare, but
Well, Mark,
I just want to understand it better.
Our friend George Mackey in the audience is saying no. I don't know which question he's adding. He's answering with the no, but he says Treasury stock is contra equity.
Right.
So.
Right. So it's actually showing.
I'm getting some votes for what I'm saying, Mark. So,
because,
since neither one of us are accountants, we should probably wait to have the accountants weigh in on what these things have, what kind of meaning they have.
I will have the discussion with George because, again, as you and I discussed, I still can't reconcile this notion of Apple buying back billions of dollars worth of shares and literally tearing them up. Now, they may have funded some options and executive compensation with some of it. I get that. But in general, they've maintained a zero balance for their treasury stock. And they don't all do that. So I want to understand, why would one do it and another one not do it? So we'll be taking a closer look. So here's just some examples. Again, as I mentioned, ExxonMobil just spent $40 billion. You can see it right on their financial statements to purchase another company. So you can see the different things that can be done, including compensation, employee compensation that is done with these. So just like George said, this is the situation from the accounting side down here. That's what's meant by the contra equity asset. Or accounting. But then I look at the companies on the right, and again, we think that we have done ourselves a pretty good service by paying more attention to the total liabilities. But the reason I left the long-term debt on here is just to make a point. In the case of McDonald's, for instance, they don't have a lot of cash, and they have this for liabilities, but their treasury stock would completely offset those liabilities if it was used to pay them off.
Mark, George is telling us he's a CPA, so I think there's your reference. Okay.
I would definitely will spend some time talking to George.
Okay.
Because I don't get it. These numbers are not insignificant, and they don't make that big of a dent in the proved calculation, believe it or not, with a couple of exceptions. But again, you're going to find treasury stock reported by probably 80% of the companies out there. That's a rough guess based on what I've seen so far. So I want to understand it better. I want to understand how significant it is. And again, this kind of came up in a discussion which we will probably take on next week. A company like NICE, probably not the best day to be talking about them, but a company like NICE, who uses a certain amount of their share repurchases for employee compensation. And we can take a look at it in the context of this formula, either the top or the bottom, but basically talk about using the mechanics here of deferring cash-based income today, using some of this type of stuff in the employee compensation field. So I want to understand that a little bit better. That's pretty simple. All right, we'll leave it at that for now. I will huddle with a couple of accountants that I know and love, and we'll see what we can come up with.
Mark, Jim Clark out in the audience also has some comments to make, and you might want to contact him as well.
Okay.
All right.
Sounds good. And we'll probably put a post up in the forum as soon as I can figure out what question to ask. Again, for me, the most important question is, why in the world would Honeywell look like it did and Berkshire Hathaway look the exact opposite? and excuse me, Apple basically retiring those shares. All right, so here's just a little bit of foreshadowing. Just wanted to add a couple of quick reminders. I added a great quote to the top of the page there, and that really does drive our best small company effort. We think that they should have the same characteristics as our great medium and large. And again, we'll have Ken go through his two-part series over the next couple of weeks as we air out a number of the sources. All right, here are some of those sources that we will glean through, ricochet off of over the next few weeks. You guys all know these pretty well. Here's a quick look at the list that came out last Thanksgiving, which has to serve as our list for this year, but we'll make sure that all of these are in our coverage. I think, Ken, actually, you said that you found a couple of study opportunities on this list almost a year ago.
Yeah, and well, I own a nice stake in Technoglass. I'm awfully glad that I discovered it a year ago, and there it is at the top of the list right there. So the 20 that are on this list, this is the top 40, I'm sure, but the top 20 I know are already covered in Manifest. I have not looked at the top 40, but I'm going to assume that most of them are covered, Mark.
Most of them are. I think a couple of them may have gotten around me. I'm not sure I recognize this one, but we'll take a look and get them in there, and they'll be part of the party for sure. All right. And in order to support this effort, just wanted to make everybody aware of when you go to the stock screener on Manifest, we have added a revenue category. So you heard Ken and I debating a couple of weeks ago, do we put some type of and this is not, I repeat, not etched in stone, but do we put some kind of a maximum? And we've had anything from 2 billion a few years ago to 3 billion now as just kind of a soft target for a maximum revenues. Those are trailing 12-month revenues for these companies. And we find that when you go in looking for companies that are in their sweet spot, a quality rating of 60. And by the way, Ken, I think it would be neat if we could do 60 and increasing. Wouldn't that be kind of cool?
That'd be wonderful, yeah.
And double-digit growth, you get this list. So that's kind of a starting point. Other companies will have to come. Some of them will drop off as they are audited and confirmed. But a whole bunch of these companies have been a part of recent conversations. Some of them are on this year's list. What are your thoughts on looking at? Go ahead.
I think it also would be helpful, Mark, to know from somebody in the banking industry what constitutes a small bank, because we have included banks on our list in the last couple of years, and we've never really gotten a definitive idea about what is a small bank. We know it's not based on revenue, it's based on assets, and my gut feeling is that assets around 6, 8, 10 billion, I'm sorry, that's wrong. Assets around 5 or 6 billion probably make up a small bank, much bigger than the assets we might look at for revenue. But all in all, I would like to find from somebody in the banking industry what they consider to be a small bank. What are the numbers for that?
Yeah, because we'll have to do some gymnastics on that one also. Axos Financial does make this list, but the fact of the matter is very few banks are going to be much more than 12% unless they're pretty special story. So we're always more careful with banks. And keep in mind that Forbes used to exclude all financial institutions and banks.
Yeah, not just banks, but anything, almost any financial company, especially brokerages and things like that.
Yeah. So, and we've certainly been rewarded by taking positions in companies like Axos over the years. So we'll have some fun with this and be building it out nicely and challenging. And just wanted everybody to be aware that revenue listing had been added. Could also put a minimum price on here also, stock price. Whether it's $5 or something like that to keep up the penny stocks. Ken believes that that's at least some form of protection from me and my early stage companies as we do this kind of a list.
From LAZR, if nothing else, okay?
Hey, we're still hoping for $5 on that one too.
All right.
All right, so good stuff. So stay tuned. We will be going back to that. Next week, we'll also include our monthly look at the Buttonwood portfolio. Here it is as of today. So we have a couple $100 ready to deploy, Ken, and probably a stock to be challenged. I've gotten a little bit warmer on ACM after doing a little bit more research, and we did pick Lamb Weston for the recent roundtable. So those are on the short list.
And I'm just pointing out that Viva is the lowest par on the list, and it's a good practice to look at one or two of the lowest pars on your list and not throw them out of the portfolio, but certainly submit them to a challenge to make sure that they're still in the place you'd like them to be.
Yeah, and sometimes a company like that will be presenting a bit of an opportunity spike, if you want to think of it that way. So we'll take a look at these also. And so far, so good. I will have a rate of return for you and all that kind of stuff with next week's session. Here's your weekly reminder that we archive all of these presentations, including the bull sessions and the round table. The September one is there. I just didn't update the picture, mostly because I didn't want to take us off of the swimming pool one just yet. Just kidding. And then in terms of coming attractions, again, keep in mind that Ken's going to go through his two-part series on where to find the best small company ideas. Dovetails nicely with our effort, the next two sessions. And then at some point down the road, we're going to be taking a look at a suggestion made long ago by Nick from New York, Nick DiVirgilio, to take a closer look at this book. I've not finished reading it, Nick, but so far I'm not disappointed. We obviously have some different perspectives, but I'm encouraged by what we're going to do with that. Okay, anything else, Ken?
No, it's been a good session today, Mark. I enjoyed myself.
All right, you behaved fairly well. We'll do the rolling around in the alley later. No, I think those are good subjects to wrestle over, and we look forward to that. I love the picture on the left. Not that rescuing humans isn't important, but there's an awful lot of those critters that are left standing on rooftops with nowhere to go, and I think that's just a great picture. Maybe I miss my dog too much. Could be. Picture on the right is what we hope one of our favorite vacation spots looks like in the near future, because it doesn't look like that today. That's Indian Rocks Beach, Florida. It doesn't look anything like that this morning. All right. Anything else, sir?
Nope. I just want to say goodbye to everybody for this session and hope we see you again in a week for the roundtable.
Send your questions.
I'm sorry, for the bull session. Yeah.
Yeah, please send any suggestions or clarifications, but don't send hate mail. I'm not in the mood for hate mail. I'm just trying to understand better. And I think that's the spirit of the Modern Investment Club movement. Let's understand it and decide what makes sense for us to use and not to use. Good stuff. All right.
Good afternoon, everybody.
Take care, everybody. Good luck.